Hello, everyone, and welcome back to the Indy Real Estate Investing Podcast. I'm your host, Jeremy Tallman, and with me today is my good buddy, Spencer Sutton. Spencer is the Vice President of Marketing for Evernest Property Management, a very large company, a company we know and love, based out of Birmingham, Alabama. Welcome to the show, Spencer.
Roll Tide, Jeremy. Thanks for having me.
You know, it's funny, Spencer. My last recording of this, I was with Josh Hines, who's also in Birmingham.
Oh, that's right. He is. Josh is a good buddy of ours.
Birmingham guys. That's a lot. That's a lot of Birmingham.
It is. There's something about the Southeast that just must be. You must love the Southeast.
Yeah, I guess so. But so Spencer, you're a marketing guy. In fact, I think we have a new intro to this podcast. So I think I'm kind of excited to hear that. I don't know what it's going to be honest with you, but we're working on it. We've done this podcast now for more than 3 years. I didn't know that until just like 10 minutes before I logged in here.
That's great.
Yeah. And we've had the same intro. So Brooke in our marketing wants to break that up. And I totally agree. So, but I brought you on here today, Spencer, to talk about the 5 biggest mistakes investors make. And I think you're highly qualified to talk about this topic. This is not like we see this a lot in our space, like the 5 biggest mistakes, 5 biggest things, all these different 5 or 7 of that you can do.
Yeah, it always needs to be an odd number, by the way.
Yeah, that's right. Odd numbers make sense. But you have a very unique perspective into this. Can you talk about how you made your way into Evernest, and then what it's evolved to, not as a company, but your role within the company in the last 10 years or so? Because there's a lot to talk about there.
Yeah. I'd be happy to. So I started my investing career back in 2003. I had bought, I think the previous year, maybe a year and a half earlier, I had bought with some friends a couple of Moe's Southwest Grill franchises. So these were restaurants. And they're fast casual restaurants. It was kind of created out of Atlanta. We bought a couple of the franchises and opened up 2 stores. And we were just like passive investors. And we hired these people. And it was it took about 12 months to realize that unless you're going to be living and breathing, this restaurant life, that it was going to be very difficult to manage as like a passive investment. And so we were like, well, what else can we do? What else can we get into? So in 2003, we bought a Homevestor franchise, which Homevestors is based out of Dallas, but they're the people that have the big yellow signs or the big billboards that say, "We buy ugly houses." So back in 2003, 2004, there wasn't a lot of sophistication from a marketing standpoint to buy houses, especially deeply discounted houses. And so we were the first ones in Birmingham. We bought this franchise. We started, I think, spending $5,000-$6,000 a month in advertising. Our billboards were everywhere all over the city, and the calls just started coming in. So we started buying houses, and we started wholesaling houses out to other local investors. So this was before the rise of the out-of-state investor, kind of before that became very popular. So we were just selling to local people, and it was going really, really well. A buddy of mine, I sold a house to. His name is Matthew Whitaker. It was his first investment property, and he was all gung-ho. He was young in his 20s, and I suckered him into buying some crappy house and that had fleas in it, actually. I'd never even been in the house. It just had a ton of fleas because I had a buyer go in there, and he was covered. But I sold that house to Matthew, and so he bought a Homevestor franchise. So Matthew and I became buddies here in Birmingham. We were friendly competitors, but we were on an ad council together. So we pooled our money resources together to buy as many billboards as we could. Then we started doing direct mail, which back in the day nobody was doing direct mail. We were killing it, and then everything was great. I mean, we thought we were the smartest real estate investors in the world, but we didn't realize it was really just a big bull market, right? Yeah. so we were buying all these houses, and then in 2008 came, right? The great financial crisis. Yeah. And at that point, I had about 30 rental houses with some partners, and then Matthew and his partners had about 30 rental houses. All of our business went away. Like we went from making very, very good money to making nothing. And because our life, like we were just wholesaling houses, and that was our cash. That was how we were operating the business. That's how we were paying ourselves. And we had these rentals, but they weren't what we were living on. And so at that point, Matthew started Evernest, and I started a nonprofit called Never Thirst. And I started traveling really because we were drilling wells and providing clean water in really remote parts of the world. So I was traveling internationally. So when I knew Matthew had started Evernest to manage his properties and maybe a few other people's properties, I went ahead and gave him my properties. Like, I can't manage these. Like, I had just gone through an eviction myself, and I was like, that was the worst thing. I don't want to do it again. So I trusted Matthew, and I was like, I'm going to give him all my properties. So that was kind of the genesis. The birth of Evernest was in 2008. And then Matthew and I went and ran that nonprofit for about 5 years. And then in 2014, Matthew came to me and he said, hey, I was out of the nonprofit, so I wasn't doing that on a day-to-day basis. I'd kind of moved into marketing, and I told him one day, I said, man, your marketing is really horrible. I can probably help you. We just had lunch, and I was just looking at his website and stuff. I was like, ugh. It was called, the company was called GK Houses at the time. And I was like, I could probably help you. And he goes, well, I want you to come on board and help us get to 25,000 doors under management.
25,000 doors. And how many? And how many did they have back then? Yeah,
at that point, Matthew, I said, well, how many do you manage now? He was like around 500. And we're just in Birmingham, and we have about 7 or 8 people on the team.
So for context, I mean, 25,000 would be the biggest company in the country back then by far, I would think.
Yeah, no, I asked him, I was like, well, how many people have done, he said, nobody's done this before. I was like, wow, okay. So he kind of cast this vision.
Big goal.
I like that. Like, I was like, did I want to go and be a property manager? No, I don't want to be a property manager. I mean, that's why I gave him my properties. I didn't want to manage.
Right.
And so I joined because I loved the vision. He said, you can come and run marketing. Well, I didn't know that when I came on, I was also going to run sales. So he was like, we fired the salesperson that was there, and he said, Spencer, can you take over? So I was like, yeah, I'll manage the sales and marketing. And so what I started doing was, previously I'd already had 10 years of real estate investing experience, being a landlord, buying and selling houses, talking to all of the other real estate investors in our market. Then I went to fielding all these calls. Like, I started taking all these calls for investors, and we started to expand from Birmingham to Nashville to Little Rock to Chattanooga to Denver to Atlanta. So as our company started to expand, I was talking to more and more investors, like from all over the country, because this was, 2014, 15, 16 was the big kind of the boom of that out-of-state real estate investor and also institutional investors. Yeah. So we started managing for some institutions, and so that was kind of that was my foray into Evernest, and it really, I just kept seeing the same issues over and over and over, because sometimes we were catching investors on the front end because they were calling us and saying, hey, I'm thinking about buying this property. What do you think? Yeah. But a lot of times we were getting calls and they were like, hey, I've bought this property and something's not right. And I was like, okay, well, let me figure out what's not right. And it became very, very obvious the mistakes that people were making. And so I did this for a number of years. Like, if I hadn't talked to thousands, I've talked to many hundreds upon hundreds of real estate investors about their issues, and just about their scenarios, but some good and some really, really bad. So that's kind of my the backstory to why I'm very passionate about educating real estate investors.
So just to close that loop, you guys set the vision for 25,000 doors by the end of 24. Is that what it was?
Yep. By the end of 24. Yep.
And you basically hit it, right?
No, we didn't. No, well, we got close. We're like 20,000 now. We got close. It's been a tough couple of years in the market. We've had more churn than we expected, and so I would love to say, yeah, we hit it in December. because that was our 10-year goal.
Right.
But we didn't, so we're just shy of it. And we went ahead like 2 or 3 years ago. We went ahead and set another 10-year goal because that's kind of what traction teaches you to do. Is like, hey, when you're a couple of years out from hitting your goal, you need to go ahead and set a different one. So we set a different target by the end of the decade to be at 250,000 doors.
Yeah,
we don't know how we're going to do it, but that's the goal. So,
that's a lot. I mean, what is we'll move on from this quickly, but what's the biggest, like, who has the most doors under management today in management companies?
Oh, that's a great question. I want to say maybe Home River Group.
Well, I knew Home River at one point had like 40,000. I don't know. I think they've lost.
I think they're
a lot
in their
of that,
30s. I think they're somewhere in the low 30s, I think.
Yeah. So I think you're probably the second largest management company in the country. You're in how many markets? 30 some markets?
No, we're in 50 markets if you count the ones that are on our wall that we're not in, like Cincinnati. No, I'm kidding. We are. No, we're in I think right around 50 markets. Yep.
Wow, it's incredible. So So Scott and I flew down to Birmingham last week, and you and Matthew were so gracious with your time. And I just wonder, before we get into these 5 questions, we walk into your office and you take us back to your podcast studio, which is unbelievable. It's like you said, 4 offices basically were just demoed and opened up into one big space. And so just for give people perspective, you do 2 podcasts a week, correct?
Mm-hmm. That's right.
And you have a marketing team of what, 4, you said? 4 or 5 people?
There's 6 of us on the marketing team.
6 of us. So you guys just crank out so much content, which again, I think gives you a really unique perspective to answer this question with just so much, not only like practical experience as being an investor, but also like just hearing from all those 20,000 doors you manage, just stories after stories after stories and pain point after pain point. So I think you are the best guy to talk and curate this list. Earlier this week, I said, hey, send me your top 5. You sent me 10. I think you could have probably sent me 50.
But, right. We could have kept going.
Yeah. So I kind of curated this down to 5 that may probably, I thought there were some ones I hadn't seen before. I thought would be interesting to talk. And so let's get into this. The number 1 top mistakes that investors make is trying to time the market perfectly. And I feel this one. So go ahead and give me your perspective on that.
Yeah. So my perspective is, everybody wants to buy low, sell high, right? That's kind of that's what you're taught. But I actually learned this from a guy. He was so I don't know if you know who Primerica is, but Primerica is a huge insurance company, and he was one of the very first people on staff. And so he had this incredibly successful business. Well, Primerica eventually got bought out by Citigroup. So in the buyout, he got millions upon millions of dollars of Citigroup stock. And I was talking to him one day, and he was just saying, all I do is just buy the stock. And if it goes down, I buy it. And if it goes up, I buy it. And I just keep buying it because to him, his whole point was time in the market is always going to be timing the market. And so when you think about that from a real estate standpoint, I mean, everybody, and I've talked to a lot of investors who like just got in 2009 and 2010. And of course, in hindsight, when we're looking back at that, we're like, wow, how brilliant. It was really kind of luck, right? But it seemed really, really great. And what's great for them at the time, because they were able to ride, for the next 10, 15 years, just some incredible returns. But you can't, trying to do that usually keeps people on the sidelines for far too long. And the way I like to look at it is not about, hey, timing the market. It's really more about, are you finding the right deals? Are you committed to, if you set a buy box, if you set, hey, this is the type of property I want to own, this is the class neighborhood I want to own it in, then what that does is it kind of frees you up to say, as long as I get the deal or the prices that work for me, then I'll buy it. If it works for me, because, I can't look back. It'd be really difficult for me to look back and say, well, and I hear this from investors all the time. Well, I used to buy houses for $20,000 in this
That's right.
in this part of town, and now they're $100,000. I'll never pay that. Okay,
Yeah.
great. If you'll never pay that, then that's fine. You'll sit on the sidelines. I would rather, if I'm committed to buying property and building portfolio, I would just sharpen my pencil a little bit and say, okay, well, here's the market now. What works for me in this type of market, and wait on that deal. You don't have to buy at the top of the market. You don't have to buy, retail prices. You should still be buying, in my opinion, at a discount. But to me, it's just all about, does the deal work for you, and not, what's the bottom of the market. And I think people, even right now, are sitting on the sidelines, and maybe they have some cash and they're waiting, hey, what's going to happen to interest rates, and prices are softening. We're seeing that right now in the market. But you can still, to me, you can find deals. It just may be a little bit more competitive in some markets than it is in others, but there are great deals out there.
Yeah, I think, Spencer, there's people, a lot of people will procrastinate about investing. They like the idea of it. They hear it's a good thing to do, but what I call a wannabe investor, they'll always find reasons not to buy. I mean, literally, you can always find reasons not to buy. Even you talked about where it was so profitable to buy between 2010 and 15, let's say, you could argue that, well, money supply wasn't great because banks tightened up, and there's always reasons, or the demand for real estate isn't as good as it used to be. I'm a little worried that I might be stuck with this thing or whatever. So there's always reasons not to buy. I think, like you mentioned, time cures all bad deals, like bad purchases. I've talked on this podcast about, we bought a lot of sheriff sale properties, and there was one that Scott and I got our numbers crossed, and we paid way too much at sheriff sale for a property, ended up having to rent it. And if I look, I still own that property. Scott and I still own it. And boy, I'm glad I own it. We're really glad we own it.
Yeah.
We weren't happy the first year or two we bought it, but now it's it's on a great street. It performs really well. We've had very little turnover there, and it's been a great purchase, even though we bought it probably $25,000 on the wrong side of it. It wasn't great, but
sure,
time cured the bad deal.
But I think that's another important point here, Jeremy, is the fact that, if you're focused on the fundamentals of investing, and hey, you're going to buy in an area that you believe is going to be good for the long term, right? I'm not looking to, I don't want to be the pioneer in a market in a D class area that's hoping that it turns into a B class at some point. Right. I don't want to be that person. Those people get slaughtered. I'd rather, hey, do I believe in this area, this part of town that I'm buying in? And, as I look down the road 10, 15, 20 years, if I still own this, would I be happy? Or would I just be holding my breath, hoping that something turns around? I think, so that's another important part, is just, not hoping, but following the fundamentals and making sure you're making wise decisions on where you're buying and the type of property you're buying.
Yeah. All right. Number 2, underpricing or overpricing rent. Talk about that.
Yeah, well, obviously if you underprice, so I don't see that a lot. I don't see underpricing happen a lot for the most part with investors. I really, although that could be a problem, but the problem is just that, hey, you're under market rent, and maybe you learn from it. And in 12 months when that lease is up, it's your opportunity, if you've kind of understood, it's your opportunity to raise rent a little bit and get in line with market rents. But most of the time I see people overpricing. Now, I think this happens for a couple reasons. Number one, we tend to be overly optimistic in our assessments of investments, right? Nobody needs to coax us to be optimistic. We love the thought of making money, and so we're like, oh, this is going to be a great one. Number two is, I think that sellers, whether it be a real estate agent who doesn't know what they're talking about, or whether it be a turnkey provider or somebody else, maybe even a wholesaler, is usually trying to convince you that their market estimate is correct. And so if you go, like, you can look at a spreadsheet, and spreadsheets are okay, but you can, like, what we always say around here is you can torture a spreadsheet until it says what you want it to say, right? You can torture it enough to get it to agree with your desire. I really want this to be a fantastic investment, so I'm going to really finagle this. I'm going to cut down on my maintenance expenses. I'm going to, vacancy. I won't have any vacancy and all this stuff. But overpricing rent is a problem. And so what we see is and I was just talking to an investor just the other day about this. He had a property, he had it priced, and he had a ton of online viewing. Like, people were looking at his property, but nobody was going to the house. Nobody was filling out an application. And I told him, I said, well, this is a telltale sign that you're overpriced. Because really good residents that you want.
That's right.
They know what they should be paying for the market rent. And if you're pulling comps from a mile away in some of these areas where it's like block to block, street to street, you may not even be in the same ballpark. It's kind of wishful thinking. And so we tell people all the time, if you, like, the biggest killer for an investment property is vacancy. And if you overprice it, one of two things are going to happen. Number one is you're going to sit on that property for a long period of time. The good residents are not going to rent it because they know what they should be paying. Number two, if that doesn't happen, you're going to get somebody who rents that property. And somebody who's willing to pay over market rent is usually not the best resident for you.
That's right.
Because they can't rent it anywhere else, or they can't, they're going to try to slide by, especially if you're just a landlord doing it by yourself. They're going to try to slide by your screening criteria, and they're willing to pay more. Some of them will even say, I've got 2 or 3 months, I can pay it up front, and all this stuff. And you get really excited because, man, I want that money. I want that cash. I'm sitting here on this investment, not doing anything. And I've made that mistake. Like, I'm saying, this is personal experience. I did that once. And it was the last time I did it, but for me personally. But to me, that's one of the biggest problems is you just sit there with a property, you're convinced it should rent for this. Maybe your property manager is saying, listen, I promise you need to drop this by $50 to $100 or $200. They're going to know the market better than you are, in my opinion. Yeah,
I think there's some great points there. I think one of the ways you can almost guarantee a poor resident is to overprice your rental property, right? I mean, it's true because they have very few options. They're going to go whatever option they can get, and they don't care if they overpay. But yeah, I think there's true. I want to talk about underpricing just for a minute, because when I look back on when Scott and I started acquiring a lot of properties, and then we really moved into like flip mode, we were so focused on flipping, and frankly, we kind of let the rental business kind of just go into cruise control, and we're kind of passive about rent increases and just kind of let people skate along. Well, then we started the third-party property management. We got some really good people into our system, and it became very evident we were underpriced. We were lazy. Yeah. We weren't keeping up with the market. Now, look, I think there's a fine line you got to play there in terms of, always being right at the market probably isn't going to do you any good, but being within a certain range makes sense. And so we had to, methodically work through our portfolio and get people up to what we consider into a market range. And you collect a lot more rent that way, right? Especially as many properties as we own. So it is true. I don't think it makes a ton of sense that every time you have a renewal just to keep the rent the same. There's some cases where that could make sense in a softer market, or you just are like, there's no way I want a vacancy now, so let's just work as hard as we can to keep the person in there. But you have to run it like a business. You have to keep your numbers in check, and underpricing. And really, it's not necessarily at the outset. It's just as that person renews year after year, hopefully, that you kind of try to keep pace. Because look, most residents will accept a rent increase at some level. They understand that. That's right. Everyone does. So,
well, this is also the issue is, like, if you overprice and you get let's say somebody's moving in from out of town and they need a place to live, and they're a great resident, and you're overpriced, and somehow they rent your place. Well, guess what? They're going to get smart about this and about within that 12 months, and then guess what you're not going to have is a renewal.
Yeah,
because
that's
they're going
right.
to say,
They'll
hey,
figure it out.
I could move 2-3 blocks down the street
Yeah.
and have the same property, a better property or whatever, and pay $200 less. And so even if you get somebody to rent that overpriced, you're not going to have them for long. And the biggest killer is just you can't turn a property every 12 months. You'll never make money in this business.
Yeah. Real quick and we'll move on. I think another way people will overpay is if there's like 4 roommates and they're like, well, it's only $300 a piece or it's only $400 a piece, but they're gone after a year. I mean, you almost guarantee that.
That's right.
That type of. But
that's right.
All right.
That's right.
We'll move on. Number 3, giving up too soon. This is painful. Go ahead and talk about your thoughts on that one, Spencer.
To me, I think people get into this business thinking a couple of reasons why. They love the thought of being a real estate investor. All right, so everybody has this dream of like owning real estate. And it's pretty cool to say you're a real estate investor, right? Like it's fun to talk at cocktail parties. Well, what do you do? Well, I just invest in real estate, whatever, which is fun. But however, I think that if you don't have a good why behind what you're doing, like why you wanted to become a real estate investor, more than likely you are going to be tempted to give up too soon because it's not easy. It's not a set it and forget it type of business. It's not some passive investment. Like if you want a passive investment, you just go buy an index fund or something because this is not that. This is going to take active management. Even if you have a property manager, there's still going to be decisions that you have to make. There's still going to be issues you're going to have to deal with. You're still going to get capital calls for your property more than likely. Yeah. And so it becomes, it's not always easy. And so the question is if you don't have a good why to like what you're doing, then the temptation again is going to be to quit. It's a lot like working out. Consistency is always going to win. If I go into the gym today and I haven't been in a long time and I lift a lot of weights or whatever, I'm going to be sore for the next week. And the temptation is going to be to give up. But if I just keep going and keep dealing with the pain, then guess what? It gets easier and easier, and the rewards are long term. So what we always say is this is not a get rich quick business. This is a get rich slow business. Yeah. And if you are not prepared for that, if you don't have a 20 to 30 year mindset to this business, then you will get very, very discouraged because the cash flow won't be what you think it is. And the loan pay down is slower than you wanted it to be. And the appreciation, it's just, there's a lot that goes on, and the repairs mount up and residents move and you get upset at your property manager or at your resident. And it's just, it's again, it's just not, it's not passive. You've got to work at it. And so I think people are really, really, they bail out as soon as they face troubles.
Yeah, we see it all the time, and I think it's sad in some ways. I feel for the people because I know they're hurting, and it's like maybe you just don't have the stomach. I mean, I don't say this, I don't think, but it's like some people don't have the stomach for this. That's the reality. Yeah, because it is a grind. It's tough.
That's right.
Let me ask you this. Do you guys, this is something we've been talking about recently, it's related to this topic, but I was talking to our brokerage manager a couple of days ago, and she said, we're telling people that don't expect to make any money in the first year or two doing this. Like when you buy, so we help people buy properties, and it's like when you come into our system, you're not going to make money the first year. You're not going to probably make money the second year. Have you done any content around that or thought through that with investors on recalibrating expectations? Because it always used to be, I think Birmingham's similar to Indianapolis. It's smaller, but I think it's similar type of market that you come in and get cash flow just day one, boom, that mailbox money's coming in and you're loving it. But we know that's changed. Because I think there's a ramp up now to make any positive cash flow at all.
Yeah. That's something I don't know. That's a great idea. I don't know if our salespeople or our brokerage people, because we help people buy too. I don't know if they're having those discussions, but they should be. They should be, because to me, to have a great relationship with an investor, you need to have proper expectations. Yeah. And what I see from most people who sell, so I think it's really good that y'all are having these conversations, because most people who are selling properties, whether it be turnkey, wholesale, whatever, they paint the best picture.
Sure.
They paint, the spreadsheets are always going to tell you massive appreciation, great cash flow that's growing every single year.
Yeah.
And it's, this just, it's wishful thinking. I want people, when I talk to investors, what I want them to do is I want them to stop and think and really consider, like, what happens if something goes wrong. I think that's what we don't do enough. I think investors are overly optimistic. As a matter of fact, I pulled up a quote I want to read because I love this book called The Road Less Stupid. It's a guy named Keith Cunningham. He made millions and millions. He went bankrupt and he grew a business. But one of the things I love what he says, and this is for real estate investors, he said, taking risks is mandatory for progress. Nothing happens without taking a risk. The goal is not to eliminate risk, although that's a pleasant fantasy, but rather to identify and understand them by questioning our assumptions, thinking through second-order consequences, planning for problems, and minimizing and mitigating the cost and probability. So if investors went in with more of that mindset of like, I know there are going to be problems, what are they? What can I foresee happening? How can I mitigate or minimize those problems? I think they would probably last longer in the business, and they would have a better expectation. To your point, maybe I shouldn't think about making money my first or second year, and I should look at this like maybe I'm going to make money in my 10th year or 15th year, and when I have the loan paid down, if I have a 15-year mortgage, man, at the end of 15 years, it's going to be incredible. But most people are wired for instant gratification. They're not wired for delayed gratification, and that can end up being a problem.
Yeah, because frankly, there's a lot of bad information out there, right?
There's a ton of it, yeah.
We worked with a group that was out west of us, I'll say, and kind of the leader of this group was in our office several years ago, and he's like, we tell all our clients that real estate's like an annuity. It's you get that monthly paycheck and you get the appreciate. It's just, I'm like, whoa, that is not the message. So as you can imagine, a lot of people that referred to us, they churned out quickly because it's like, this is like, not what I expected.
I'm not getting the check that I wanted every month. Where is it?
All right, good stuff. Number 4, not having adequate reserves. Tell me your thoughts on that.
Rough. This is rough, man. This is rough because it kind of goes back to the previous point of people like ditching this whole thing. And a lot of it is because they don't go into it with eyes wide open. And if you're not properly capitalized, you just assume that like cash flow is going to pay for everything, and you just don't know. I mean, unless you're really, really confident about big CapEx expenditures, like you have a new roof when you bought it, you have a new HVAC, you have a new hot water heater, there's going to be CapEx at some point. There's going to be maintenance, especially if you're buying. I know that Indianapolis has older house stock like Birmingham does. If you're buying an older house for a cheaper price in a D-class neighborhood, and you're excited about placing a Section 8 resident in there because the government's going to pay you every month, guess what? You're going to have more expenses than you think.
Yeah,
you're going to have a lot more than you think. These older houses need more maintenance. The Section 8 residents live in them more. They're flushing more toilets, flipping more light switches. And so I think investors don't go into it thinking, hey, what are my reserves for vacancy, for repairs and maintenance, for CapEx? But this is a part of running a business. You have to be prepared for that. And what we've seen is so many times, unfortunately, we've had to lend the investor money because we've had to replace the HVAC because it's out and it's July. And July in Birmingham is like living on the sun, and so we can't leave this resident without an HVAC. So we have to spend our money and put $6,000 HVAC in, and then because they weren't capital, they didn't have enough money. So what they end up doing is they end up paying us back through the rent money that comes in every month, and so they don't see any money in their account, and we're taking it all, and we're like, hey, this is a part of owning property. It's like a part of owning a business is doing this. And I think that's, I'll tell you one story that this is an extreme story, but it blew me away. And I don't know if I've told you this before, Jeremy, but we had an investor. She called in, I spoke with her, and she said, I've got these properties. I bought them turnkey and this property manager's not helping me. They don't want to rent them. And I'm like, okay, well, that's a warning. That's a warning right there. Okay.
Sure.
So tell me your story. She had been to a guru seminar, paid $40,000 for this training.
Oof.
Then bought these houses I can't remember, she had 2 or 3 or 1. I don't remember. We went and walked them. We went and walked these houses, and we came back to her, and we said, listen, in order to rent this, these are the things that have to be done. So this is called like a rent ready walkthrough. In order to get this property ready to rent, here's our walkthrough. These are the punch list items that you have. And she said, I don't have any money. And I'm like, well, she goes, you've got to rent this. I said, we can't. I'm sorry. It's not safe to put a resident in there. So get this. She started a GoFundMe page.
Wow.
She was asking people for donations, and her whole premise was, help me provide affordable housing for people. I need to raise money to fix these houses. So she was asking people for money to donate money so she could fix her rental properties up that she shouldn't have bought in the first place. Yeah. And I'm like, that's an extreme case, but to me, that's just kind of indicative of people have these assumptions that everything's going to be beautiful and perfect, and I'm going to have tons of money, and the cash flow is going to pay for everything, and it's just not the case.
Yeah.
So sorry, I just kind of rambled on there. But,
no, that's good.
I'm kind of passionate
Great story.
about it.
Yeah. Yeah. I Spencer, I think as an industry, like property managers and investors, like we have to recalibrate maintenance, right? I mean, all of our pro formas need to add a hefty additional percentage to maintenance. They just do. I mean, because rents are not keeping up with the cost of maintenance. Mm-hmm. You and I talked last week about a graph that Ray Hespin did. He owns a company called Property Meld, and how he showed normal inflation over CPI. CPI from 2019, I think, until like May of this year, and then above that was the average cost of an HVAC repair. I think it's went up over 80% since 19. Yeah. So it's
which is incredible.
Yeah, it is. It's very expensive to own properties, and to expect cash flow to cover, honestly, even just normal repairs and maintenance, let alone CapEx, it's not going to happen. So what are you telling people? Like, first, how are you approaching reserves with your clients? I'll ask that question first.
I was going to ask you the same thing, actually. So of course we talk about reserves. I haven't been in on a lot of the sales calls lately, but we have a $500 reserve per property, and then once you get over 5 properties, if you have 5 properties with us, it's just like $100 per property.
Yeah.
So if you end up having 10 properties, you've got $1,000 reserve for us, and that's really just to take care of the little things that are less than. We can go out there and fix it for a couple $100. We're going to go ahead and do that. But anything over a certain threshold, I can't remember what the threshold is, either $300 or $500. We're going to call you and say, hey, here's the issue. Mm-hmm. What do you want us to do about it? Here's our estimate. You can get an estimate if you want to. But so that's what we're talking about. But I actually was speaking with an investor who's done very, very well. He's got 300 paid for properties in Memphis, and he's a hard money lender now, and he's just a great guy. And he always tells investors, count on 20%, set aside 20% for maintenance, and
20% of your rent.
Yeah, that's right. 20% of your rent, set it aside for maintenance. He's like, the 10%, forget that 10% is way too low. 20% is what I tell everybody. And he's in Memphis, so he's got, he's talking with a lot of investors in Memphis. So they've got older house stock and kind of the same type of areas that we have in Indianapolis and Birmingham. So
yeah, we've honestly been more aggressive now. We've historically told people 6 months of rent in an account, like in a reserve account.
Okay,
right. So if it's $1,000 a month rent,
not with you, not in your account.
No, not with us.
As a reserve. Okay,
you're
telling them, hey, set this aside.
Right. No, I don't think they would want us to hold that. I can't imagine that being a great thing.
It wouldn't be
for
great,
anybody.
No.
But no, putting 6 months aside. Scott we were talking about this recently, and he had an idea of, I think we've been talking about this more with our group, is just setting up a line of credit Like you can go out if you've bought a home, presumably you're credit worthy at a certain extent. Right. So you probably go to your local bank and get a $25,000 line of credit, unsecured, interest only, or not interest only, but just it wouldn't cost you anything on an ongoing basis if you didn't draw from it.
Right.
But it's better than just like parking a bunch of cash somewhere in an interest account. That's not so great, although recently I guess it has been better. But that kind of made sense to me. Now, look, you are maybe like deferring it because it's like, well, you're gonna have to draw on it if you have turnover or whatever.
Yeah.
But it's not like, to us, like you mentioned before, speed is so important, turnover especially, and also just repairs and maintenance. Going back to what Ray said, Ray indicated you get one bad maintenance issue a year with a resident. If you have more than that, they're likely going to churn out. They're not going to be a non-renewal. So he did this presentation about how maintenance directly impacts renewals, and he has data on that, which I thought was fascinating. So I think if your air conditioner goes out, tenants are going to give you a little grace to say, I know you need a day or two to get it replaced or fixed, but if you need 2 weeks to raise money to fix that air conditioner, that's a big problem, right? And so it's not if they're going to probably renew, it's they're going to not renew, probably. So yeah, we've been thinking lines of credit. It's a quick, easy way to get cash. I think could be some downstream ill effects to that, but it does create better speed in the whole process, which helps you in normal repairs and maintenance, and also particularly turnover to get that property turned and on the market as quickly as possible.
I agree 100%. I mean, you want to keep, if you have a great resident, you want to keep them there as long as possible. I mean, if you can keep them there 5-10 years, then fantastic. So we started partnering with a company. I know we were talking to you about it last week, that actually does financing for major repairs. And so we're offering that now to clients. It's like, hey, here's the turn. It's going to cost you $15,000. You've had a resident who lived there for a long time. It's going to cost you $15,000. And if they don't have that set aside, then we can finance that for them. But I just would encourage people to have money set aside. And again, you're thinking long term, right? So you're thinking, I know it's painful in the short term, but long term thinking would have you go, how can I take care of the asset, which is not only the property, but the resident? How can I take care of that resident so that asset stays there and continues with me as long as possible? Yeah,
because going back to the AC or the furnace, because in Indianapolis, it can be like an ice block, not like the summit, like an ice block in the winter. It can be very cold. And, say it's $6,000 or $7,000 to replace that furnace. You need to get it replaced because if you have a vacancy, it's going to cost you more than that. So you're going to spend the money, right? So it's like, why not improve your property in the same time, and get it fixed. So, all right, number 5, save the best for last. Maybe. Not understanding property management. And we could probably spend a few hours on this,
but we won't.
I'm curious your take on that. Like, what do you all see when people come into your system just don't really know how things work from a property management standpoint?
I think a lot of times people have been sold and they believe what they want to believe about how the asset should perform, how the property should perform, what the process should be like. And especially if they've been sold something from a turnkey provider who doesn't manage the property or whatever, or an agent, they come in just thinking that, hey, you're gonna solve all their problems for them. And unfortunately, a lot of times we can't solve their problems because maybe they've bought the wrong property, maybe they bought at the wrong price, maybe they bought in the wrong place. And so, like, one of the things I always talk to investors about is, like, does your property have any what we call white elephants, which are like a white elephant is something that you couldn't ignore, but you can't move either. And so this would be something like a steep driveway, right? What are you going to do about a steep driveway in a house? Residents don't want a steep driveway in Indy because when it ices over, what are they going to do? Like, how do they park? And nobody wants a property on a busy street. Nobody wants a property with railroad tracks behind it or huge power lines right next to it. Or they don't want a house with a funky layout. So if you've bought one of those properties with a white elephant and you come to us thinking it's going to be so easy to rent, well, you're wrong. It's not going to be easy to rent. What's going to happen is you're going to have to lower your price to account for a defect that you bought with that property. And I mean, listen, that's why I love helping people when investors call us and say, "Hey, should I buy this property or this property?" That's a great opportunity to say, "No, don't." Like, you're going to be better off if you paid a little bit more, but got a different house or got in a different area. So I think the expectations, to me, and I talked to our sales team about this. I'm like, don't set unrealistic expectations for these people. Yeah. Don't encourage their thinking if they're brand new and they come to you and thinking that this is just going to be the best thing in the world. You need to really, really be very clear, because what salespeople do in our company, if they don't do that, is they set our onboarding team up for failure, or they set the property manager up for failure, because there's going to be problems, there's going to be issues, and they're not going to be prepared for it. They're going to think, well, that's your fault. And listen, I'm not saying we don't make mistakes, because we do. Every property manager does. Like, every property manager does.
Sure.
But I think a lot of it is people come in with this expectation that you're A, going to be perfect, or B, you can overcome their mistakes on the acquisition side.
Yeah, I think that's true. I think it's, you mentioned agents that may have set someone up with a bad property, like, hey, everything's great, send it right, and then when it doesn't work out, it's like, well, it must be your property manager. Let's get you a different solution, right?
That's right. That's right.
So,
that's right.
I'm
always weary about somebody who says, well, these other two property managers didn't work, and I'm like, oh boy, well, this is a problem.
Yeah,
you may be the problem. It may not be your PM.
I think it's good to be the second manager, because you may just reaffirm some things. Being the third manager should be there should be some warning. You should be kind of cautious as a property manager to pick on someone who's been through two other management companies, unless there's just been catastrophic. Look, I'm sure in your market, certainly in this market, property managers fail. They do. They're here one day and they're gone. There's like any other business. But you were talking about the white elephants, and it reminds me, Spencer, funny story. Scott and I purchased a home at sheriff's sale a long time ago. It was just west of here. And it was just beat. I mean, just in terrible shape. I think it was one of those we bought in the teens, so it was not in great shape. Yeah. So we had to spend a fortune to get it up to even like someone could live there. It was
rentable.
Yeah, it was terrible. And we wanted to flip it. We couldn't flip it. So we ended up renting it. And it was just always kind of a drag on our portfolio. Like, we had some really bad move outs, and it just wasn't great. And so the story is, and we knew it when we bought this, we were right beside a power plant. Right. And you would go there, and it'd be bzzz, that buzzing noise you get by a power plant. So not a great homey feeling when you pull up to your, walk into your front door. But we had, when our last turn happened on the property, the person just did a really bad job and left all kinds of stuff and in bad shape. And we spent a lot of money to kind of get it back. I'm like, look, let's just sell this. This wasn't the time where you could sell anything. Like, you could just pick a number, sell it, and it would sell. And so we were in that market. And it's like, there's really no better time since we've owned this property to sell it. So we decided to sell it. And I go over there, and not only was there the buzzing that was happening on the right side of the house, there, and this is in urban Indianapolis, there was a rooster crowing non-stop. I mean, non-stop. And I was talking to our contractor. He's like, yeah, it just goes on all day. Like, I was like, wow.
Just what a resident wants with kids.
Just what a resident wants.
Yeah, that's right. With a new baby.
Crowing. Yeah, but no, I think you're right. I think there is a learning curve. I do think we enjoy people. Typically, we have good success with clients who come in and say, hey, I own in Memphis, and I own in Colorado, and I own here, and now I'm looking. Those people understand property managers, right? Correct. They understand the role. Now, we're all a little different. We have different little processes here and there, but they understand it. So there's not a big learning curve to get them up to speed on what we do. The toughest, I think, are ones that have, and I've taken calls like this over the years. It's like, so what do you guys do exactly? Like, so do I just like pay you 10%, the tenant pays me, I pay you 10% of the rent or 8% of the rent or whatever it is. And so they have no idea.
Does your 10% cover maintenance? That's what I get that question.
Oh, yeah.
I'm like, oh boy, this isn't good.
Yeah. So I do think it's not understanding. And I have, friends who are seasoned investors, and And they tell me all the time, what you guys do is tough. Like I really value what you do. I admire what you do because it can be really difficult because we have legal and statutory requirements for the house that we have to make sure are being met. Right. And those are kind of non-negotiables in terms of maintenance.
Yeah.
So if a furnace goes out, we're statutorily required to provide heat. Right.
That's right. That's
and
right.
In Indiana, if central air exists at the time the tenant took possession, you have to maintain that central air. And our policy is if you provide appliances, you have to maintain those appliances as an inducement to rent. So there's just certain things that when you get that mind shift of, we're helping manage your customer, right? You're our client, but we're really helping manage your customer and trying to give your customer a good experience so they will renew, which is what everybody wants. But sometimes there's a little tug of war and a push and a pull there that we have to manage through that can be difficult. So,
and that's what I think investors miss is exactly what you're saying. It's just hey, listen, you are our client, and we want to make sure that you have a good experience. But the only way that you're going to be successful is if we take care of this resident
That's
here.
right.
Because going back to the Ray Hesman study, if we keep ignoring certain problems with the property or that they're having, then guess what? You're going to turn this person over. And it happens. Unfortunately, it happens a lot. And also, kind of going back to overpricing, underpricing rent, we've had this happen a lot when somebody buys a property sight unseen. They haven't been to the city. They hadn't been to the street. Right. And they've looked at Google Images online and looked at the street, but we go there and we're like, oh, by the way, Mr. or Mrs. Investor, did you know that across the street is a burnout? And then right next door on one side is a vacant lot with high weeds, and on the other side is a vacant house that's boarded up.
Yeah.
Just want to let you know you're going to have some serious problems. And they're like,
and a rooster crowing.
And a rooster crowing, and you're like, hey, this is reality. Unfortunately, we're not magicians, so we can't pull something out of our hat or out of our butt. But so that relationship is really, really important. I really think I'm a huge believer that investors should talk to local property managers before they buy properties. 100%. We know things. We know way more about these properties and about these markets than anybody that you've probably ever spoken with.
Yeah,
I would trust a property manager because they're the ones that are going to have to deal with your problems, and they're more than likely going to tell you the truth.
Well, especially one with scale, right? That has managed, a bunch of homes and a bunch of different neighborhoods, and just has a whole lot of reps inside of an area that you want to invest in, because
that's right.
We probably have data on pretty much every neighborhood in our city. Truth be told,
that's right.
We know what homes rent for. We know what people will renew for, and it's not that we're better than a real estate agent. It's just that we have a different specialty than that real estate agent. We know rents. We're really good.
That's right.
I talk to agents. I give talks around, our town a little bit, and I tell them, you can engage a real estate agent, but before you write an offer, talk to a property manager. Make sure that number that is, to me, where you start your pro forma rent is going to be within a certain range. You got to be very comfortable with that, because there's nothing more difficult than, I'll say it is difficult when you have a client come in through your system that said, hey, I just bought this property. I need a manager. And we sign them up and they're like, yeah, my agent said 1,500. And we're like, no, it's probably 1,100. Right. And so that's so deflating. They lost $4,800. So I was like, oh, well, that's all my cash flow. Market doesn't care. Market doesn't care. That's right. Yeah.
You have to think about, for an agent, what are they incentivized to do? They're getting a check at closing, and then they're moving on to something else. And we always say you date your agent, but you marry your property manager.
Sure.
So you want to talk to the person you're going to marry. You want to make sure it's a good fit. You want to make sure that what you're buying it makes a lot of sense from their perspective. Because, Jeremy, wouldn't that be just a great conversation to have? Hey, my agent said 1,500. I'm about to buy this property. What do you say? And you come back and you tell them 1,100. Guess what they're going to do? They're either going to reduce their offer or they're going to withdraw their offer.
That's right.
Right?
And look, we see it all the time. We do.
Yes.
We have people all the time. When Jake, our business development manager, says, hey, what do you think about rents? I think it's this. My Zestimate says this. And Jake says, well, no, it's that. Okay, thank you so much. How about this one?
Yeah, that's right. Yeah, that's not going to work.
It's smart.
Next.
It's smart to really get that local expertise.
Agree.
Of someone that just does it all day long, every day, right? It's what we're
all
good
day
at.
long.
So, well, Spencer, this has been great. I appreciate all your time. If people want to reach out to you, what's the best way to do that? Or do you want them to?
I don't have an email or phone number anymore. No. I would say, they can reach out to me. I have an email, ssutton@evernest.co, or they can, you've got a great podcast. We have one that's we're bringing on investors from around the country. It's called the Evernest Real Estate Investor Podcast. So if you want to listen in, then we'd love to have you.
And you're a good follow on LinkedIn too.
Oh, yeah. I've started posting a little bit more on LinkedIn.
Yeah. That's great. Well, thanks for being here, Spencer. It's been really
good.
Jeremy, good conversation.
Thanks for asking.
Yeah. We hope everyone has picked up some information that will help them in their investing. We'll be back in 2 weeks with another podcast. In the meantime, we encourage you to share this podcast with your investing friends. Leave us a review and don't hesitate to reach out to us with any questions. Until next time, thanks so much for listening, and please stay invested in your investment.